Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two great beaten down stocks to consider buying for long-term gains as the market hits new highs. And those two stocks are Align and Chipotle. But before you get everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So we're going to have a quick market recap before we jump into Align and Chipotle and why you might want to buy these as the market tries to hit new all-time highs. So we saw NVIDIA finally hit all-time highs on Wednesday. I'm recording this Thursday midday. We also saw the NASDAQ 100 tracking QQQ ETF hit new records as well, driven by NVIDIA and some other big tech names. And now we have the broader S&P 500 and the NASDAQ inching right below their all-time highs on Thursday midday. And this is all backed by cooling Middle East tensions. So investors are betting that the President Trump-backed ceasefire between Israel and Iran will lead to a sustained peace. Now that we're confident that a major conflict will be avoided, Wall Street seems to finally be sending market-moving tech stocks such as NVIDIA to these new highs following the rally that began in early April. And cooling inflation, trade deals, and potential for strong second quarter earnings provide a bullish backdrop heading into July, which has been a historically bullish month. So with that said, though, investors might start taking profits on some of these stocks. If you start buying things in early April, some of these stocks are up 50, 40, 30%, some even more. So you could see a near-term pullback maybe heading into second quarter season, which kicks off roughly in the middle of July. So there's a good idea to maybe look into some stocks that have not necessarily participated in the rally that are trading well below their all-time highs. So with that in mind, we're going to take a look at the first of these two stocks, which is Align Technology, which trades in ticker ALGN. It is currently a Zacks ranked number 1, a strong buy stock, and it's trading over 70% below its all-time highs. Despite trading over 70% below its all-time highs, it's more than doubled the S&P 500 in the last 15 years, and it's neck and neck with the benchmark in the past 10. Align is the company that makes Invisalign, so those clear braces. The firm's clear aligners have permanently reshaped the orthodontics industry, and Align grew its revenue at an impressive rate. And then it soared during COVID. The company then came under pressure against hard to compete against stretch and cooling sales. It's facing headwinds across the industry as well. So they said last year that dental practices and industry research firms have reported deteriorating trends, including decreased patient visits and increased patient appointment cancellations, along with fewer orthodontic case starts overall, especially among adult patients. So the company's facing those setbacks due to economic pressures, such as inflation, that have made elective dental procedures less affordable, hurting sales. So fewer people are getting Invisalign because it's expensive and often considered cosmetic, and they're just facing a huge pull forward from the initial COVID rush, which we'll touch on in a minute. So there's also some increased competition and margin pressure that's weighing on the stock. On top of all of that, simply grew far too overheated during COVID, and it was never going to be able to live up to those trends. So if we look back, their earnings at one point in 2020, their GAAP earnings spiked 307% year over year from an impressive period of growth before that as well. But at one point, they went from $5.53 in GAAP earnings to $22.45 per share the next year. So that was going to be impossible to compete against, and that's kind of what the stock is up against still at the moment. So we'll just dive into some of the basics and then look into maybe why you want to buy Align down 7% from its highs. So its advanced clear aligner system has really shaken up the orthodontic space over the last 20 plus years as people look for viable alternatives to traditional metal braces. It works hand in hand with dentists and orthodontists to help customers through the entire process from start to finish. It has had success, massive success, and it's inspired different competitors such as Smile Direct Club, which is actually already out of business, which shows that Align's kind of first mover advantage and its ability to actually work with patients. It's not all online and where you scan your teeth at home and things like that. So people actually work directly with their orthodontist. I actually use this to fix a gap in my teeth. That I had traditional metal braces as a kid and I stopped wearing my retainers. So just a shameless plug, I have used them, and it was like I didn't want to get braces to fix one little gap in my teeth, and I used the aligners for I think about 6 months. So they do work very well, and it's very hard to tell you're even wearing them. So they've treated roughly 20 million patients, and some of these patients have never had braces before, and now they're getting actually a big business of people who are getting these as teenagers. So that's a growth market going forward. So they've treated roughly 20 million patients, and it's expanded its wider digital services as well. Patients love that it works hand in hand with orthodontics. And as I mentioned, the key teenage demographic is huge, as it successfully attracts more people who might have otherwise got traditional metal braces. The firm also last year unveiled what it called a breakthrough in its scanner technology, 3-time wider field of capture and a 50% smaller wand that delivers faster scanning. So this is the orthodontists and dentists scanning your teeth to give the company the ability to make those cleared Invisaligners that then move your teeth. So their most recent quarter, it celebrated that 20 million mark. It also noted that their clear aligner volume increased 2.2% quarter over quarter and 6.2% year over year, with growth across all their markets. Their volumes for teen patients was up 4.5% sequentially and 13.5% year over year, driven by continued adoption of its Invisalign First program. So as I said, getting that teen market is huge, by getting people who might have otherwise just got traditional braces, whereas before it was mostly adults who didn't want to have sort of the stigma of metal braces. People see that. But despite those strong trends, its revenue was actually down 1.8, so 2% year over year, and mostly impacted by foreign exchange rates, which is hurting the stock in the near term. It did also top our Q1 earnings estimate by 8% and noted that fiscal 2025 was off to a good start, with volumes up both sequentially and year over year, reflecting strength in both teens and adult patients across all of its regions, which is a good sign. It also said it's worth noting that Q1 was its highest year over year growth rate for both adult and teen patients since 2021. So that's a good sign that maybe after that big pull forward for a few years, people who didn't get that during that initial COVID rush are kind of, they have a new crop of people, and they'll kind of get back to maybe more standard business as usual going forward. So it did also mention their tariff updates. They do make their clear aligners in different operations: Mexico, Poland, and China. For the U.S. domestic market, they're currently manufacturing their aligners in Mexico prior to shipment in the U.S. It does also currently ship or makes its clear aligners for the Chinese market in China. And it did say that they don't expect much tariff impact, and that its products had been imported in the U.S. compliant with the U.S., Mexico, Canada agreement. So this is as these trade deals get made between all of the key U.S. trading partners, if Align seems pretty upbeat that they're not going to be hit too hard by any possible tariff headwinds for their business. So with that in mind, the company is expected to do about 11% adjusted earnings growth in 2025 and another 9% growth next year. And we're expected to do about 4% revenue growth in 2025, and then 6% revenue growth next year to get up to about $4.4 billion. And its earnings estimates have trended higher since its Q1 release. So its revenue, or its adjusted earnings estimate for 2025 is up about 5%, with 2026 up about 3.5%. The stock is still up 1,200% in the last 15 years. This is versus the S&P 500. It's 500%, and it's up about 200% in the past 10 years to roughly match the benchmark. Yet it's down 30% now over the last 5 years and trading roughly 73% below its all-time highs. It just recently, in the last few months, found support at its super long-term 200-month moving average. So that's kind of where it is now, trying to find support at that really long-term level. It's also trying to get back above its 21-week moving average after finding some buyers near its lows over the last roughly 5 years. So trying to find some support. It's still, though, it's not, if you're a total technical trader, it might not be like the most, the best setup possible. But as I said, if you're looking at a really long-term chart, it's a positive sign that it did hold at that really long-term 200-month moving average. And the stock is trading at a 33% discount to its median, historic median, and nearly in line with its sector, even though it's up 200% in the past 10 years versus sector's 4% dip. So it's currently trading at 21.3 times forward 12-month earnings. And over the last 15 years, it's traded as high as 77 times forward 12-month earnings. So as I said, it's trading at a 33% discount to its median, even though it's up 1,200% in the last 15 years and 200% in the past 10 years. It's also worth noting that on May 6th, it announced a new $1 billion stock repurchase program. And this is after its last $1 billion authorization that it announced in January 2023 was completed in May of 2025. So they're putting their strong balance sheet and their cash flow to work. So it's always a good sign that the company's showing that maybe it thinks its stock's on sale and it has a ton of cash to do it. Its balance sheet's really strong. It currently has no long-term debt. It has $6.1 billion in total assets versus just $2.3 billion in total liabilities. Shareholder equity sitting at about $3.8 billion. As I said, it's just rolling out a new $1 billion stock repurchase program. And obviously, there could be still more near-term headwinds, but getting your teeth fixed won't go out of style anytime soon. Some of its new age upstarts faded pretty fast and their business is still working really strong. It just faced a kind of a crazy period where people were sitting at home. They were flush with cash, some that the government gave them, and just not much else to do. But hey, if I was ever thinking about getting my teeth fixed, I'm going to do it now. So it's going to be hopefully back to more business as usual, and they won't have to compete against those crazy stretches of growth. So certainly worth putting Align Technologies, which is now a Zacks ranked #1 strong buy, on your watch list heading into July, trading over 70% below its all-time highs. And now we're going to move on to another beaten down stock. It's not trading that far below its highs, but we're looking at Chipotle, which trades in the ticker CMG, Chipotle Mexican Grill. That's what the ticker stands for. It's down 20% from its highs, yet the stock is still up 150% in the past 5 years. It's dealing with a tough to compete against stretch. And the fact that its CEO, who Wall Street loved, who helped kind of turn around the company, had left for Starbucks last summer. Still, it's a giant of the restaurant space with huge upside and great growth. So Brian Niccol took over as Chipotle chief executive back in March of 2018 after he came over from Taco Bell. The new boss didn't really do much crazy, didn't really tweak anything to help fight back against some, at the time, this now seems like forever ago, back in 2018 when Chipotle was suffering from setbacks from some foodborne illnesses and people were just a little off of the company. Instead, it focused on regaining its crown as kind of the standard bearer of the growing fast casual industry through consistent menu, fresh quality ingredients at a relatively, especially these days, affordable price compared to everybody else as well. On top of that, it jumped headfirst into digital and mobile ordering, to kind of get into that business when everyone like Starbucks, McDonald's was doing it all. So that's where they are now. They're facing a little bit, as I said, setbacks. The fact that their CEO left last summer to go to Starbucks. Starbucks plucked him and paid him a lot of money. Their new CEO came from in-house, so he took over after he was the interim CEO, and then he took over in November of 2024. He had been with the company for a long time, Scott Boatwright. So nothing has really changed much. It's just that they're kind of like the Wall Street CEO that everyone loved, or the CEO that everyone in Wall Street loved got replaced. So that's kind of always going to be a little bit of a setback. But still, in 2024, the company did about 15% revenue growth. They had done about 14% revenue growth in 2023, 14% in 2022, 26% in 2021 after doing 7% in 2020. So they went on a massive run over the last few years, which was going to be pretty hard to compete against. And their earnings went on a huge run as well. So their earnings over the last few years, they were up 25% last year, and this is on a GAAP basis, 38% the year before that, 39% before that, and 83% the year before that. So a huge run, which, as I said, a lot of these companies, once you come up against a really difficult to compete against stretch, the stock's going to take a hit, and its earnings revisions have gone sideways and down more recently. So the stock currently ends a Zacks rank #3 hold, and its estimate revisions, as I said, have trended in the wrong direction. But hopefully they're bottoming it out here. So over the last year, Its 2025 estimates down about 7.5%, and its 2026 estimates down around 6.5%. Its most recent quarter, total revenue actually increased about 6.4%. So that's not a great sign compared to, as I said, this is compared to 15 and 14% growth the last few years. And its comparable sales actually decreased 0.4%. So that's what Wall Street's a little nervous about, is how are they going to match up against this massive growth run? And are they going to be able to keep churning out these double-digit revenue growth, and especially that comparable store sales growth? They're obviously confident that they're going to be able to continue to grow. They have a brand that a lot of people love. I personally go to Chipotle a lot, and I know that in terms of pricing, they're relatively competitive, especially when they're offering a quality food that's made fresh. Some of their pricing is similar to a McDonald's meal, but you're getting, and once again, this is my opinion, you're getting a much better quality food for, at some point, Chipotle burrito is less than, say, like a Big Mac meal at McDonald's. So I think long term, that's a pitch they're going to be able to continue to work on. That's going to draw more consumers. So that said, though, they're going to do 8% growth on the top line in 2025, and then get back to 13% growth in 2026. And on the bottom line, we're calling for 8% adjusted earnings growth, and then 18% growth next year. So back to bigger growth in 2026. After a little bit of a slowdown in 2025. Though what could be dragging the stock down is that we're only calling, this is Zacks estimates, calling for about 0.8, so less than 1% comparable store sales growth in 2025, and this would be against 7.5% the year before that, roughly 8% in the prior 2 years. So that's kind of the little bit of a worry, is are they going to have this really slow comps growth of just less than 1% going forward? We only have an estimate for 2025, so hopefully it'll turn around in 2026, but that could be what possibly holds the stock back in the near term, is when can they confirm they're going to get back to a little bit higher comparable store sales growth. In terms of its performance, the stock over the last 15 years is up roughly 1,900%. This blows away the broader retail wholesale market, which is up around 650%. So as I said, it's up 1,900% over the last 15 years. Over the last 3 years, the stock is up 104%. To really outpace its industry, its sector's 60% run. That said, it's down 21%, so roughly 20% from its highs of, this is from its highs were in actually June of 2024. Meanwhile, its sector is up 16% of last year. So it's down 21% from its highs, and while at the same time, its sector is up 16%. The company is currently trying to get right back above its 200-day moving average. As I record this, it's facing some resistance, so that could be the level that traders might start getting back in, or longer-term investors might want to look at. It's trying to break above that 200-day after holding ground recently near that 50-day, and it's now shot up. And maybe if the market continues to ride and more investors start to look for some beaten down stocks with more near-term upside, the Chipotle could finally break above that 200-day. And it's also trying to break above its longer-term 50-week moving average. And then in terms of its valuation, it's trading 50% below its highs. It's still, I guess you could say, this is pretty pricey stock for a restaurant company. It's trading at 42.1 times forward 12-month earnings, which is well above its sector, which is trading at 24 times. That's at it's 50% below its highs, and it's roughly at its 15-year median, despite the stock going on that massive run. So you are getting some value, but maybe investors are getting a little worried that it's like, if you just don't know much about the company, 42 times forward earnings for a restaurant does seem possibly a little high, but compared to itself, it's trading at 50% discount and right at its own 15-year median. Wall Street's still relatively high in the stock. So of the 32 brokerage recommendations, 20 are at strong buys, 3 are at buys, and 9 are holds. So we have no sell ratings for Chipotle. So overall, as I said, if you're a longer-term investor and you are upbeat about its business model, even though it's facing some tough to compete against periods of growth, possibly put Chipotle on your radar heading into July, trading 20% below its highs in terms of price and 50% below its highs in terms of valuation. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.